All right, we're going to go ahead and pick up where we left off in Chapter 9, Accelerators. We're in the very last video. We're going to wrap it up here in this video, this Chapter 9 on Accelerators, and we're going to end with an introduction to taxes and fees. So try to fill a leaky bucket by pouring in more water, and you'll see that the harder you work to fill it, the more water leaks out through the holes. You have to work harder to keep the bucket from running dry. The bucket in this example symbolizes your accumulated wealth. The water represents your income, and the holes illustrate the various taxes and fees owed to the government, federal, state, and local, and financial service providers. The act of filling the bucket with water symbolizes your hard work and effort to hold on to your money. When you are holding this sieve-like pail, you may think that the only way to fill it to the brim is to grind harder and earn more money. However, it doesn't matter how hard you work and how much more income you generate, the holes are still there, draining off a portion of your efforts. The underlying issue, the holes in the bucket, needs to be addressed. In your quest to accumulate wealth, the process is not only about working harder, it also involves implementing smart strategies to minimize your tax burden and lower fees, thereby preserving more of your hard-earned income. You need a plan to plug the holes. When you lower the fees that you're charged and familiarize yourself with tax strategies, you get some corks to plug the bucket, so you can keep more of your earnings. With fewer leaks in your bucket, your wealth is not disproportionately absorbed by taxes and fees. It accumulates quicker and is more beneficial to you and your family. Taxes are situational, therefore you should consult with a competent tax professional regarding your specific needs. In all cases, tax planning should be done within the framework of legal tax avoidance and not tax evasion, which is illegal. The importance of reducing fees and taxes. When deciding between two identical items you want to buy and all other factors are equal, the one that costs the least is the best choice. It is a no-brainer. The same is true for index stock funds or index bond funds. The lower the cost, the more of the returns you keep. Again, all else being equal, it will put you ahead of the majority of investors who don't consider the cost of their investment funds. Reducing taxes and fees is a crucial strategy for building and preserving wealth. Taxes are often one of the largest annual expenditures for many households. The taxes impacting families the most include income tax, social security tax, sales tax, and property tax. Unlike wealth, which can appreciate without generating a taxable event, income is taxed as soon as it is realized. Thus, managing how and when income is recognized can significantly impact financial growth and stability. All right, so minimizing taxable income. Minimizing your tax burden requires a two-pronged approach, balancing realized income and investment growth. Realized income is the money you earn and receive, which is subject to current taxation. Unrealized gains, on the other hand, refer to increases in the value of investments, such as property or stocks that have not been sold. Taxes on these gains are deferred until they are realized, meaning the asset is sold at a profit. You can reduce your current tax obligation by implementing strategies to defer income recognition and prioritizing investments that grow in value without generating immediate taxable income. Tax-efficient investment strategies. Investing in tax-efficient funds outside of tax-deferred accounts can significantly reduce the amount of taxes you pay on your investment gains. Favoring funds with low dividends and low turnover can help in this regard. Qualified dividends, which are taxed at a lower rate than ordinary income, may be beneficial depending on your income level and tax bracket. Tax-efficient index funds and tax-managed funds are specifically designed to minimize tax burdens. Tax loss harvesting, selling investments before year-end to offset gains, is another maneuver to optimize your tax situation. Likewise, you may benefit from postponing the sale of profitable investments until after the new year as a strategy for deferring tax payments, allowing more of your money to grow before taxes are due. Additionally, consider holding investments over 12 months to ensure that gains qualify for the lower long-term capital gains tax rate. Finally, most retirement accounts have tax advantages that should be woven into your tax planning. Leveraging corporate structures. Incorporated businesses can capitalize on significant advantages bestowed to corporations. For example, corporations protect business owners from personal liability, shielding their personal assets from business debts and liabilities in most cases. This structure not only offers financial protection, but it also optimizes how and when income is taxed. For individuals, the formula is earn, pay taxes, and then spend. However, the formula for corporations is earn, spend on necessary expenses, and then pay taxes on the remaining income. Corporations can use pre-tax dollars to pay for legitimate business expenses such as business-related vehicle expenses, insurance, and travel, provided these expenses meet IRS requirements for being ordinary, necessary, and properly substantiated. The corporation is then taxed on its net income after these expenses have been deducted from gross income. By changing the formula and putting spending before paying taxes, corporations are able to reduce their tax burden significantly. However, owners must carefully comply with tax laws to avoid penalties, and C corporations may face double taxation on earnings distributed as dividends, unlike pass-through entities such as LLCs or S corporations. Comprehensive tax management. Tax management is a puzzle with many different pieces. To solve the puzzle, you must manage your tax obligations as effectively as possible. You therefore need a clear understanding of when and how you are taxed on various aspects of your money, on earnings, spending, savings, and even inheritance. Aided by this knowledge, you can develop strategies to optimize your taxes at each stage. Look at the big picture and take a comprehensive approach to tax management so you know how to select tax-efficient investments, maximize corporate tax advantages, and control the timing of income. For example, tax-efficient investments in retirement accounts may defer taxes, allowing you to keep more money working for you longer. Proactively managing your tax burden is a cornerstone of building and maintaining financial independence. By implementing thoughtful strategies and complying with tax laws, you can reduce unnecessary tax liabilities and preserve more of your wealth. Okay. Turbocharge your FI. The road to financial independence is comparable to a marathon rather than a sprint. It requires endurance, consistent effort, and the ability to navigate unforeseen obstacles. The financial accelerators, entrepreneurship, and higher risk, higher return investing discussed in this chapter serve as turbochargers, potentially shortening your journey by increasing your income streams and investment returns. However, they demand a deep commitment to continuous learning and a willingness to embrace additional risks. Entrepreneurship is your first accelerator. It offers the possibility of creating significant wealth from an idea and turning it into a sustainable income source. This path is filled with uncertainties, but it also provides enormous opportunities to increase your cash flow. Your business becomes an engine that fuels your financial growth, allowing you to reinvest profits into higher risk, higher return investments, thus initiating the second accelerator. While there are certainly risks involved in the second accelerator, these types of investments have the potential to achieve above average market returns. You need courage to take these risks, but you can mitigate some of them by remaining disciplined and following a clearly defined plan. Don't jump into a higher risk, high return investment until you have established a solid business income engine. That way, any potential losses will not jeopardize your initial investment income engine. Remember that the path to financial independence differs from person to person. Your personal goals and unique circumstances dictate your journey. The accelerators we discussed in this chapter may help you speed up your journey to FI. If you decide to use the accelerators, Take time to understand the probabilities and perils involved in implementing them and how they will fit into your long-term FI strategy. Also, remember, for the highest chance of success, tackle the steps in order. Steps 1, 2, 3, and then 4. All right, so that ends Chapter 9, Accelerators, and we're just going to end this video going over our next step. So I need you to believe entrepreneurship and higher risk, higher return investing are viable methods to accelerate my journey to financial independence. Examine, am I interested and ready to take calculated risks and learn more about entrepreneurship and higher risk, higher return investing? Do I have the patience and persistence to navigate the challenges that come with these paths? And then act. If you are interested, begin exploring business ideas that align with your skills and interests. Focus on scalable businesses that fill a need large enough to eventually produce at least hundreds of thousands of dollars in annual profits. All right, so that wraps up Chapter 9, Accelerators. Thanks for sticking with me through Chapter 9. It's a lot of good information, a lot of things to think about, and we'll go ahead and pick up with the next chapter, Chapter 10, in our next video. Take care, and we'll see you real soon.